Good afternoon, everybody, and welcome to our first Lunchtime seminar. As advertised, today is about UK tax implications of buy-to-let properties. And I'd like to introduce you to our expert, Martin Holden, who is the founder and director of MJH Tax Consultants. Good afternoon, Martin.
Holly, thank you for the invitation. As you mentioned, my name is Martin Holden, a chartered tax advisor, and I've been specialising in providing both advisory and tax return completion services for expatriates and investors into the UK property market. What we wanted to talk about today was the four broad taxes that you will encounter in your journey through the purchase of UK properties. So those are going to be stamp duty land tax, income tax, capital gains tax, and then briefly at the end, because it is a complicated subject in its own, inheritance tax. So if we look at stamp duty land tax first, essentially it's a transaction tax. So this is a tax which the UK government charge on pretty much all new purchases, whether they're new build or whether they are existing properties. And as you can imagine, that tax is payable to the HM Revenue and Customs. So long as pretty much 75% of the purchase price is paid on completion, so you pay when you finalise the purchase of the property, then that is when the stamp duty land tax becomes payable. The rates did exchange slightly in 2017. The main change in that respect was that there's an additional 3% charge where properties, where at the end of the day of that property purchase you own more than one property, and that includes all properties that you own worldwide. So if you own a property in New Zealand, say, or you own your own home in South Africa, then if at the end of the day of the purchase of your UK investment property, then there are some additional charges that become due. In terms of how you will encounter this tax, it's not necessarily that complicated. Your conveyancing solicitor should calculate those charges for you. The process is that on completion, you transfer your funds to the conveyancing solicitor, or the bank will transfer the funds to them, and the solicitor will then pass over the balance of funds due to the vendor, the person that you're buying the property off, and the stamp duty land tax over to the Revenue and Customs in the UK. If you go online, there's a number of calculation tools, but the calculation isn't necessarily too complicated. And if we look at the next slide, then we can see the rates which apply. So as I say, over the last few years, the methodology of calculating stamp duty land tax has changed a number of times. However, the position we have at present is that you look at the purchase price of the property, the proportion of your purchase price that falls within the band 0 to 125,000. If it's your first property, then the rate is 0. Conversely, if you buy a property for, say, let's say a £300,000 property, then in that case the first 125,000 will be charged at 0. The next £125,000 you'd pay at 2%, and the balance, which in this example would be 50,000, you pay 5%. And as you can see, the more expensive the property is, the higher the stamp duty land tax rates are. The slightly, I suppose, uncomfortable fact is that where you own more than one property, then the additional rate of stamp duty land tax applies, and you can see there's an additional 3% charge on that. I think what most purchasers do nowadays is simply amortise that. They look at it, they say, okay, I'm going to hold the property for 40 years, maybe less, and that's a transaction cost which will amortise over the period of ownership. And also it's deductible when and if you sell the property, so you will get tax relief for capital gains tax purposes. That's stamp duty land tax, that's the purchase of the property. And then we're going to move on to income tax. Now this will apply where people are buying properties for investment purposes, or maybe they see the property as their main home, but they want to rent it out in the meantime and achieve a revenue source from it. Okay, moving on to income tax. Most people will be looking to rent their properties out, certainly if it's an investment property, and indeed if it's anticipated as being the main home, maybe receive some income from that before they move to the UK. Even though you are non-resident, income arising in the UK and capital gains from residential property do retain a UK tax liability, and that's the case regardless of the double taxation agreement between the UK and, for example, South Africa. So if you have a tax liability in South Africa and you also pay tax in the UK, then income tax should be allowed as a credit against your South African liability. Their profits fall within a £32,000 band, so most people will be able to benefit from personal allowances, which means roughly the first £11,000 of profit is tax-free. The next 32,000, so most people will be able to enjoy over £43,000 of income. In joint names, £86 of income. The tax rate is at 20%. But there's also what's called the non-resident landlord scheme. So essentially the UK authorities don't like the idea of rent leaving the UK without having any control over it. So they apply what's called the non-resident landlord scheme. When you rent your property out, if you make no application to the UK authorities, then either the letting agent or indeed sometimes the tenant are required to withhold tax at 20% of the net rent and pay it over to the revenue. That tax is reclaimable at the year end, but alternatively you can register for the scheme and have the rent paid to you gross without deductions as you go. And once you've registered for that scheme, that scheme reference or registration stays with you for life, and if you change letting agents or you acquire new properties, you simply use that reference to be allocated to the new agent so that you can receive rent gross at that source. So the process for obtaining what's called your non-resident landlord scheme registration is you can't really make that application until you know who your letting agent is. So once you've purchased the property and then appointed your letting agent, you then need to complete what's called a form NRL1I, which applies to individuals, and there's a separate form if you use a non-resident company. It's a relatively straightforward form, but obviously what it does is divulge your details, your name, address and letting agent details and your expected gross income to the UK authorities. It's possible at the moment to make an online application, but quite often it's better to do a paper one. You keep more of a data trail, and it's not always easy to identify where and what the reference is when you make an online submission. But when you submit that return or that application to the revenue, essentially what you're doing is agreeing to keep your tax fares up to date, agreeing to pay your tax or any income tax which is due on time, and also agreeing to submit tax returns which are required. And relatively quickly, within 4 to 6 weeks, you will receive what's called a non-resident landlord scheme registration number, and that will also be copied to your letting agent. Your letting agent can backdate that approval for up to 3 months before they receive it, and from that date on they should be paying you gross without any deductions. But of course you will then subsequently need to submit annual tax returns and keep your tax fares up to date, because where you don't do that, then the revenue can withdraw those approvals to receive the rent gross. But at this stage, it's very important to be aware that it's not it's not an exemption from income tax. It's just an approval to receive the rent gross without a withholding tax.
Can I just ask a question on behalf of our listeners at this point?
Yeah, of course. Yeah.
Okay, so postal is a big problem in South Africa, getting paperwork out of the country and anything that needs to be returned. It takes, I mean, the time is just ridiculous, and sometimes the majority of the post gets lost. Mm-hmm. So online is by far the preferred route for South Africans. You mentioned it's not impossible to do. Which would be better, to do the online or to appoint an agent in the UK?
Well, both are possible. I mean, I do have clients in South Africa who get the approvals to me. In that case, where post is difficult, then it would probably make sense to do the online application for the non-resident landlord scheme. The fact is, when we move on to income tax returns, non-residents should not be using the revenues software. So in that case where I act, I tend to, what is possible is to do tax returns, send them out as a PDF, and then have the approval to those returns submitted by email. The alternative for the non-resident landlord application is to do the same, have the return completed, PDF it out to the client, and then courier it back, the hard document with the signed form back. What I would also add is the UK tax system is going digital. We're going to have digital tax returns in a couple of years, and at that stage I'd imagine that everything will be online.
Mm-hmm. Okay, thank you.
I say, you have two options. You can either apply for the non-resident landlord scheme, which will enable you to receive your rent gross and enable you to probably budget better and pay your tax, if any is due, at the end of the year. Or you can simply elect to have the tax deducted at source by the letting agent and pay it over to the revenue. And some clients do that. You will then, of course, either way, fall into the UK tax system. And if you register for the non-resident landlord scheme, you will need to do tax returns to continue your approval with it. If you choose not to register for the scheme, then you'll want to do a tax return to reclaim the tax, because almost certainly too much will be deducted through the year by your agent. And this is one of the slight difficulties for non-resident landlords, in that you will need to complete a self-assessment tax return, but at present, before the tax system goes wholly digital, you will either need to submit a paper return by the end of October, or you will need to submit an online return. So for non-residents, whilst it is technically possible, you should not be using the revenue software online. So you can register for self-assessment, you can register to go online and look at your tax affairs, but you should not use the revenue software because it's not structured for non-residents, and it will assume that you are resident in the UK and expect you to declare your worldwide income, and it won't ask you the correct questions with regards to your residence status. So that leaves you with two options. One is you buy your own software, or you appoint a professional such as myself, needless to say, who is able to submit online tax returns for non-resident clients. And in that case, you have until the end of January following the end of the tax year. So it's probably worth saying at this stage, the UK tax year ends on the 5th of April. And you then have, so this current tax year that we're in has just started. So this tax year will end on the 5th of April 2018. We will then have until the 31st of October 2018 to submit paper returns, 31st of January 2019, which sounds quite a long time away, to submit online returns.
Everything that we're talking about here, there's a lot of figures and dates that are being discussed. We are recording this session, so you will get an opportunity to listen to all of these again and an opportunity to ask questions at the end of the session.
Been a few changes in the legislation which affect this current tax year. Now, of course, if you don't own property already, then this will be old news by the time we get to 2019. On the other hand, if you are an existing owner of UK investment property and you've rented the property out, you'll be experienced at claiming what's called the 10% wear and tear allowance. Broadly, this is an allowance which allows for depreciation of furniture, soft furnishings, carpets, that sort of thing. That has now been abolished, so from this April onwards, it's only as you replace your items that you can claim a deduction for them. So there's no real deduction that's allowed for the upfront cost of furnishing properties if you rent properties out furnished. And so what some clients will do is lease properties and lease furniture instead. So the lease agreement is allowable in full, and that gives you more flexibility on replacing furniture. If, for example, a new tenant comes in and doesn't want your particular settee, you don't need to worry about removing it and getting a new one in. So the other major change in legislation which is causing sort of much interest in the UK is the way that the deduction for loan interest is allowed. So at the moment, and this part of the comment is still the case, where you take a loan for the purchase of a property or to improve a property, then the interest on that loan is allowed as a deduction against the rent. So, for example, with one of your products, Holly, if it's a guaranteed net return of 8%, but somebody pays £2,000 in loan interest to purchase that unit, that £2,000 will be allowed as a deduction against the guaranteed income. However, from April 17 onwards, and slowly over 4 years, so it's being introduced over a 4-year period, by 2020, instead of the interest being allowed as a deduction, tax relief will be given as a tax credit instead. But this only affects those who have profits of over £32,000 each. So see the first column where it says currently top slice of profit is assessed at 20%. So if you have a profit of £43,000, say, in your sole name, and you pay interest of £10,000 on a loan which has been taken to purchase that property, then you'll be left with assessable profit of £33,000. The tax rate at 20% means you would have a tax liability of £6,600, which theoretically in this example needs to be paid over to the revenue. From 2020, when the rules are wholly introduced, instead of that interest being allowed as a deduction, you can see that you end up still with a £43,000 profit. 20% of that leads to an £8,600 liability. So instead of the interest being given as a deduction, you instead get a tax credit of £2,000. And you can see that for basic rate taxpayers, the result is the same. You still have a £6,600 liability. So where this is causing sort of interest in the UK really is for people who are paying higher rate tax. So they have a salary maybe of over £40,000, so they pay higher rate tax on their investment income, or maybe they've got a significant holding of properties in the UK. But as a rule of thumb, if you own a property in your own name and your profit without interest as a deduction is no more than 32,000, or you own profits in joint names and you've got £64,000 of profit, then the new rules won't affect those people. For the majority of new investors into the UK, certainly if your profits are less than £86,000 in joint names, the new legislation will have no material impact on your net return. You can see, however, that those people who do pay tax at higher rates, and this really is affecting people, as I say, who are resident in the UK, there is an increase in tax, and for every £10,000 of interest, you may potentially be paying an additional £2,000 in income tax. And I just want to stress, new investors into the UK, and I think as a real broad, sort of broad rule of thumb, if you're investing less than £1 million into the UK in joint names, you're very unlikely to be affected by the new loan interest restriction rules. This is an example. It's not really based on any sort of projected income from an investment or a buy-to-let property, but what it does show that it gives you an outline of the sort of expenses that you can claim for the current 2016-17 tax year. And the costs are realistic. So if you've got gross income of £25,000, on the left-hand side you can see the typical expenditure. So if the property is untenanted for a while, you can claim council tax and water rates as a deduction. If you have a letting agent, then there's probably going to be a management fee, and there'll be some other sort of management fees. If you renew your tenancy, there'll be a renewal fee. Service charge is a typical cost for buy-to-let properties. So where you've got a unit or a flat, there'll be a service charge. If you buy the freehold, so your typical family home, then you wouldn't expect to see a service charge. But repairs and maintenance, and then of course, as we discussed, usually the major cost for investors into property is the loan interest as a deduction. Accountancy fee, so where I act on behalf of clients, my fee obtains tax relief and is allowed as a deduction. And then from this year onwards, because we don't get wear and tear allowance, a reasonable cost there of replacing furniture. That's probably a little bit high, maybe £750. But as you can see, that results in a profit in this example of £8,900. Personal allowances, if you're entitled to them, and residents in South African nationals resident in South Africa would be entitled to personal allowances. You can see that income of £25,000 in a sole name could result in no UK income tax being due at all. As I say, that's just an example. It gives you an idea of the sort of expenses which are allowed as a deduction. And these are the tax bands. So for the current year, so we're now just into the 2017-18 tax year, if you're entitled to personal allowances, the first £11,500 of income is tax-free. So there'll be no income tax due on that tranche of your profit. The next £32,000, so there's what's called the basic rate band, you pay income tax at 20%, and then you're moving into the higher rates of tax. So the next £118,000 is taxed at 40%, and then for very higher earners in the UK, 45% on that tranche, which is over £150,000. So again, rule of thumb, if you've got £1 million of investment property in the UK, that's your only UK source income, you're not going to go into those higher rates. You're probably going to be paying some tax in the 20% band. Personal allowances is a common question for non-residents. So the rules for people's entitlement to personal allowances is if you are a UK national, or you are or a European Economic Area national, so you're a national of UK, Portugal, broadly the current EU plus Norway, then you're entitled to personal allowances. If you are not one of those, then you need to be living in a country with a double taxation agreement that provides for personal allowances. So, for example, a South African national living and resident in South Africa will be entitled to personal allowances. Conversely, a South African living maybe in Hong Kong or Singapore would not. So it's a common question, and the answer to whether you're entitled to allowances if you're not a European Economic Area national will depend on the country in which you are resident and your nationality. And this really is an example of your average rate of tax that you would pay in the UK, depending on your level of income. So if you had £43,500 of income in your sole name in the UK and you're entitled to personal allowances, you can see that in fact the average rate of tax you'll pay is 14.7%. So less than that headline rate of tax that a lot of people who are sort of doom and gloom about UK tax rates would tell you. Second example, in sole name, you can see that if you had income of over 80,000, so £87,000 of income, then those rates are going to go up. So we're talking about net profit here. This is £87,000 of profit after all your allowable deductions. Then you would pay an average rate of tax of about 27.3%. Now that's when you'll be looking at maybe purchasing properties in joint names, because if you have the same level of income, same level of profit of 87,000, then you can see that actually in joint names your rate's only going to be 14.7%, so significantly less. A quite typical question at this point, and really this is a subject for another sort of presentation, is whether you should maybe buy properties through non-resident companies. And one reason for doing that is you apply a flat rate of 20% income tax, and that's the same rate of tax for capital gains tax, in fact. So regardless of your profit, whether it's 43,000, whether it's 5,000, or whether it's 87,000, a non-resident company will pay tax at a flat rate of 20%. The downside to that is you lose your allowances, and there can be some other rules, offshore pricing rules, which apply to the proportion of loan interest, which is allowable as a deduction too. But the main point is a non-resident company does not benefit from personal allowances. So you can see that actually on a £43,000 of profit, the non-resident company will pay more tax than an individual who is entitled to those allowances. So it really does depend on your circumstances as to whether or not a company is most beneficial. And I would say again, as a rule of thumb, doesn't really fit everybody, but for your first investments into the UK, probably in your own name would be advantageous. So that's income tax. So we've moved through, so we purchased the property, and we covered stamp duty, land tax. We've rented the property out, and hopefully you're making a profit. You know, sometimes it's good news to pay income tax because you only pay if you're making a profit. But then we move on to capital gains tax. And it is important to point out that capital gains tax only really becomes due when and if you sell a property. So you do have some element of choice in the timing of paying that tax. The rules changed in April 2015. So prior to April 2015, non-residents were exempt from capital gains tax. There were some slightly complicated rules in terms of how long somebody had been non-resident for, but a foreign national investing into UK property was exempt from capital gains tax. From April 2015, those rules were changed, and residential property is now fully within scope of capital gains tax. So there are some exclusions if you buy commercial property, or if you buy purpose-built student accommodation, so in effect halls of residence, those can fall outside of charge. But on the whole, your typical residential properties, flats, family homes, are now within that tax. Any properties which you owned prior to April 2015, it is possible to claim a rebasing or a time apportionment. So it's only gain since April. It's only the gain since April 2015 that falls within charge. So if you own property before April 2015 and you're thinking about selling, you must report within 30 days of sale. If you fail to do that, then some quite draconian penalties come into place. So if you're 6 months late on a report, then you can have the penalty can increase up to £1,300 each. But it's worth stressing that online report is very simple, very straightforward, and so long as you do it on time, it's a very simple process. For people who are buying into property now, since April 2015, then broadly, the capital gains tax liability will be the difference between what you purchase the property for, what you sell it for, and allowable deductions such as cost of sale, cost of purchase. Unlike income tax, everybody's entitled to an annual exemption for capital gains tax. So the first 11,300 of your sale is free of capital gain, of your profit, shall I say, not the sale proceeds, of your net profit are free of capital gains tax. And if you purchase in joint names, then that would be £22,600. So there are some clients who will own a property in their own name. If they're married or in a civil partnership, then you can very easily transfer into joint names and then benefit from 2 annual exemptions and 2 basic rate bands. So we can see the first 11,300 tax-free, the next £32,000 of gain are charged at 18%. Then above that, the rate of tax does increase to 28%, but on the proportion of the gain over £32,000. So this is an occasion when you might be looking at, is it worth transferring the property into joint names if it's between a married couple or a couple in a civil partnership? It might be worth looking at the property to see whether somebody could live in the property for a period, because once you live in a property as your main home, then some other reliefs kick in, and again, with some detailed advice, it might be possible to reduce that capital gain quite significantly. Unfortunately, we don't have a slide here which shows the calculation of the capital gains tax, but if people want to contact me after the presentation, I can share that other slide with them. You can see that the higher rate of capital gains tax is 28%, but it's worth stressing, if you own a property in joint names and you had a capital gain of £87,000, then the average rate of tax is only 14.7. That is based on the calculation of having no other income in the UK during that year. But again, it shows that those headline rates of tax quite often don't need to apply to investment properties in the UK.
Martin, is there any difference in the fact if you are operating from a UK offshore bank account such as Jersey, Isle of Man, compared to an onshore UK bank account where you're realising these gains?
No, there's not. No. So what we're looking at is, regardless of your resident status, so even if you're non-resident, we're looking at all UK source income and all UK source capital gains potentially being within charge to UK tax. So where the money is paid to, where the individual is resident, what bank account is used, whether you have a UK loan or a foreign loan, don't impact on the tax liability or the reporting obligations in the UK.
Okay.
As we say, that's that has gone through the timeline of buying a property, hopefully producing rental profit and paying income tax, and then capital gains tax, which, as I say, is due on disposal of the property. If, however, you retain the property and you don't sell, then in the UK, inheritance tax is charged on the UK estate for people who are living outside the UK and have always lived out the UK and are born outside of the UK. So we have a concept of what's called domicile in the UK. So typical South African national who lives in South Africa, hasn't lived in the UK, but has assets in the United Kingdom, will have a potential liability to UK inheritance tax on their death on what's called UK situs assets. So if you die with UK property, you will not pay any capital gains tax. There'll be an uplift to what's called the probate value, so the value of the property on the date of death. So no capital gains tax, but instead there will be inheritance tax potentially instead. However, everyone has what's called a nil rate band. So everyone has a nil rate band of £325,000, and there was a change in legislation, well, maybe 10 years ago now, which allows the surviving spouse or the surviving civil partner to inherit the unused nil rate band of the deceased spouse. And again, this nil rate band is available to all nationalities. So whereas the personal allowance for income tax depends on your resident status or your nationality, the allowance for capital gains tax and the nil rate band for inheritance tax are available to everybody, regardless of nationality and regardless of their resident status. So We're only really going to very briefly focus on inheritance tax here. Inheritance tax is due on your death, depending on the value of your UK estate. If the assets are held in joint names between a married couple, then on the first death, all the assets will pass to the surviving spouse, or potentially can, subject to the wills, can pass to the surviving spouse with no charge to inheritance tax at that date. If there's been no gifts of UK assets in the preceding 7 years, on the second death, the surviving spouse will inherit the nil rate bed of 325,000, so that on the second death, a UK estate for what's called a non-UK domiciliary will only have an inheritance tax charge if that estate is valued at more than £650,000. So an example would be on the second death, UK real estate is the only asset in the UK. If it was valued at £1 million, say, and there was a £275,000 mortgage, that would, sorry, £250,000 mortgage, that would leave you with a £650,000 estate on which no inheritance tax would be due. And my mathematical error there was it would be a £350,000 mortgage for that to come down to the £650,000 of value. The summary of the MJH Tax Consultancy, the services that we can provide for you. The majority of the services actually providing tax returns, so non-residents still need to submit tax returns. We can provide those for both resident and non-resident clients. We can provide advice on how to hold property, when you need to report, and any tax planning that might be sensible around moving to the UK or leaving the UK and purchasing and selling a property. That's all I really want to say at the moment. I don't know whether, Holly, you've got any more questions for me, but if anybody wants to contact me by email or make a phone call to me, then I'll be more than pleased to hear from them.
Thank you very much, Martin. Really appreciate your time. Okay, now we're into the question and answer section of this seminar. If you do have any questions still to ask, please use the Ask Question button in the bottom left-hand corner of your web page now. If we run out of time to answer all of them, we will email you back with the answers. Okay, so the first question we have, Martin, when is SDLT payable on an already existing building?
That would usually be payable on completion. So when the substantial part of the completion fees, usually more than 75% of the purchase price is paid on completion, that would be the same date that the stamp duty would be paid. So usually, as I said earlier, you would expect the conveyancing solicitor to do the calculations and advise you what the final balancing payment would be, and that would include the stamp duty and land tax. So usually on completion, not on exchange.
Okay, and the second question that we have, asked by Steve, is do I have to declare my income or offshore UK income to South Africa even if I keep it in the UK?
Well, you would need to take local advice with a South African tax advisor, so it could depend on your individual circumstances. But if you're in South Africa and you're liable to tax on a worldwide basis, then I would expect you to have to report the Jersey interest as well. And of course, you need to be aware there's an increasing level of exchange of information between different jurisdictions. Some of that exchange of information is becoming automatic now. So you first of all, I'd say take some advice locally with a locally professional who's qualified to give the advice on expatriate affairs. But I would expect it to be reportable.
Thank you. And a third question, you've mentioned about this automated information sharing. Where could anybody go to learn a bit more about that, and what does it mean?
Well, that is a good question. Well, what it means is that all double taxation agreements and also more sort of informal agreements between the different tax authorities around the world allow for exchange of information. So historically, that exchange of information has been by paper versions. Different authorities literally sending a paper trail of information that they might have where it's appropriate. And I suspect that information used to sit in a dark room somewhere and was never looked at. Now there's a more automated exchange of information. So, for example, the European Savings Directive requires offshore banks to exchange information with authorities such as the UK or withhold tax at source. Probably the easiest way is to Google exchange of information with HMRC online, and that will provide more information.
Okay. This is just a note to my investors. I do have a contact in South Africa who is looking at that exchange of information, particularly from a South African perspective. If you'd like me to put you in touch with him, I can certainly do that.
Yeah. I mean, I would add that the only concern with the exchange of information is where individuals aren't reporting the income, on a timely basis and correctly by reference to local legislation. So, if you are reporting all the income that you should be, and taking advantage of the tax breaks that you may well have in the UK, for example, then the exchange of information shouldn't be a worry.
Okay. Any more questions? We're just checking if there are any more left on this session. Okay. So Martin, thank you very much for your time today. I will put in the email to everyone your contact details again, but people can follow up with you directly if they have more detailed questions.
Yes, that'll be fine. Probably the easiest thing to do is drop me an email on the email address that was on the presentation earlier, or drop me or give me a call. That'd be fine. I'll be more than happy to speak to people.
Thank you very much.
Okay, it's been a pleasure.